Okay, great. Today we have a special guest, a good friend of mine, one of our top producers. We have a Mr. Alonzo Hall joining us, and he is our IUL specialist within the agency. You know, he's an IUL specialist, so he's joining one of our top producers, and he has some cases that he's working on, and he agreed to share some ideas with us, which we can all use, right? And before we begin, I just have some updates that I want to go over. All right, before we begin, first of all, everyone, we have Elizabeth Riley, who is the regional vice president of New York. She is visiting our office in New Rochelle. So this really for the New York agents, I should say the tri-state agents. If you're available that day, she's also coming in with some people from Emeritus, actually her partner from Emeritus, and they're going to give us some updates what's happening inside the world of Emeritus. And this is an in-person meeting, and seating is limited. We have a conference room, and the seating is limited to 10 people. So if you want to come, you have to, RSVP. I sent out the punch bowl invitation, so you definitely want to RSVP on the on the site, because it's only 10. So first come, first serve, RSVP, and then the registration would be closed. And I would love to see you all in person. Secondly, the Emeritus has updated their underwriting manual, and you can find the updated underwriting manual on Producer Workbench. And the item number, if you go to the search bar, is LI1333. Once again, LI1333. And you see the revised underwriting manual from the first look of it. This just came out a couple of weeks ago. From the first looks of it, it looks like you can now do uh, exams up to all ages, up to 100. The exams start at 100,000, because before, at age 60, I believe 65, 70, um, they would have to do at least a paramed and urine. But now it looks like they can apply for up to 100,000 without doing the para urine, without any requirements. So take a look at that. That's good news. And remember, we're in the fourth quarter now. We're in a stretch. We have the trip to Hawaii, and I send out an email. You have to do 60,000 in first year commissions, which is approximately 100,000, 120,000 in premium for Meritus. So I would definitely like to see some qualifiers. So we have a full 3 months to get that done. All right. So moving on now to the IUL, right, which is the Index Universal Life. Rich really has become a hidden gem. IUL has been on the books for, I can tell you, for many years. It's always what's the best whole life policy, or the IUL. And a lot of people like the whole life for the guarantees, but the more I'm looking at the Index Universal Life, the more I'm really becoming a fan of it, because it's a way that you can grow your money tax free. You can access your money. You can grow the money tax free. You can access the money tax free, and you can also transfer the assets to your heirs income tax free. And how that's done, there's some codes in it. There's some tax codes, and these tax codes have been in the books forever, right? Forever, for a very long time. But these are the codes that allows the life insurance to function in the way it does. The code 72E, that's the tax code that allows the cash value in the policy to grow tax free. The rule 7702, that's the code that allows you to access the cash value tax free. So you can actually, your money accumulates tax free, and you can also pull the money, have access loans and withdrawals on a tax free basis. 101A, that's the code that allows the death benefit to transfer to your heirs free upon death. And then you have the TAMRA, the TEFRA, and DEFRA rules, which I really won't go in too much today, but these are some tax codes, some newer tax codes, that's been enacted really in regards to how you structure the illustration. And I was talking to Alonzo, what we have the benefit of Emeritus. If you use the software system, it'll design the program and keep it within compliance of these rules. Right. So we have a computer software that would allow you to stay within compliance on those rules. So we have that. All right. So a lot of the concepts we'll talk about today has came from, we had a book club Now we just finished up called the Laser Fund, which is a book written by Doug Andrews. If you haven't had the chance to read the book, you definitely want to take a look at it. And Laser Fund is an acronym for liquid assets safely earning returns. So liquid assets that safely earning returns, and we'll talk a lot about that. So some of the key features of the IUL, it is very liquid. You'll see it's not, unlike a 401k, with 401k, you have to wait to 59 and a half to access the cash value. You see with the IUL is very liquid. It's safe investment. They have a guaranteed interest rate of 0. So if the market crashed like it did yesterday, the market had a bad day yesterday, it's going to earn 0. So 0 is the floor. So we like to say 0 is the hero on there, so it won't go below that. The returns are predictable because they're tied in with the S&P 500. So you could pretty much predict, okay, this is what the S&P 500 has done in the prior 10 years, and see, okay, in the next few years, it should hopefully be able to mirror. And we'll talk about the lot of the tax advantages. Also, we'll talk about the power of indexing. We talk about the cap rates, the participation rates. We talked about the floor on the IUL. 0 is our hero, and also we'll go through the different indexes. And a lot of these, the illustrations were mirrored to a theory that Doug Andrew had in his book, which is close to a 5 or a 10-year story brownstone apartment building. So that he did a lot of comparisons with the IUL being the similar as let's say a 5 or 10-story brownstone. And we'll talk about the phases. There's 4 phases of the IUL. The design phase, which we'll talk about the plan design, like how do you build it, how do you do the illustration, how do you put the money into it, and then once you have the plan design, then you have to submit it, of course, for approval. Right, you have to submit it over to the underwriter. The underwriter has to approve it. You have to go through underwriting. We'll talk about the max funding because, in my opinion, IUL is really designed for max funding. If you have a client, you have your regular traditional whole life and you have your traditional term, but the IUL, this is for clients that really want to sock away some money. So we'll talk about the max funding on there, and then we'll talk about the withdrawal, the distribution phase of the IUL. So it's a 4-phase process with the IUL. How do you take the money out? So with that, I'll stop sharing my screen, and Alonzo, you can take it from here.
Thank you for that wonderful introduction, Charles. I really appreciate it. So everyone, thank you for attending. Today we're going to be taking a look at a few different case designs that I have here, and one that I've actually just started working on yesterday, using the IUL, very similar to what Doug Andrew has. So first thing, generally, when you are looking at the IUL, you are looking at a policy structured that may not fit most people, but it can. So I want to show you a couple of different scenarios, and I'm going to start here with case number 1, which is the Smiths, right? So we're going to use Will and Jada Smith. Actually, hold on. Let me stop my screen and pull up the producer's workbench. Give me 1 second here. Boom, there we go. Okay, so if we sign into our producer's workbench, okay, and we're going to go create this illustration. I've already started on this, but I want to have it live time for you guys, right? So if I do this live time, let me pull up the Smiths. All right. Don't worry about the other clients there. Just worry about the Smiths for now. We're going to look at Will Smith, right? So let's look at the case design for Will and Jada Smith. Okay, so Will and Jada Smith had $500,000 in a taxed as earned account. Okay, and they were tired of getting hammered on taxes. As soon as they learned about the laser fund's tax deferred growth, tax-free access to money, and income tax-free death benefit, they were ready to get a brighter tax future. So in this scenario, we're going to illustrate a 5-year annual fund into a laser fund. Okay, so now there were some laws that were mentioned: TAMRA, TEFRA, DEFRA, right? So you may worry about, well, what about the TAMRA 7 pay? So luckily, our software actually allows you a way out of that, right? So one of the things that we hear online very often is things like buy term and invest the difference. Well, things like laser funds, if you actually know what you're doing for your client and with your software, you can actually create that. The way that you create that, in my personal opinion, don't let my personal opinion affect how you do your business, however, because it differs for each client. So that's why it's very important to have a discovery meeting. So in this scenario, we're going to assume that we've already had the discovery meeting with Will and Jada Smith, and that they're comfortable with the shorter term of paying into the policy. So we're going to assume a 5-year structure. So if you or no, I'm sorry, we're going to do a 10-year structure. So if you assume from age 52 to 62, you would, instead of having them pay in perpetuity till age 121, you would simply enter age 62. Now you want to make sure that they're paying that $50,000 a year for 10 years, which equates the entire $500,000. The reason you want to do that is you want to make sure that your client is not hit with a terrible tax issue. We're not tax advisors, we're not giving tax advice, but you also don't want to just look out for yourself and greedily, harm your client in taxes. We're going to assume that he's a standard client. We're not going to say, he's got the health of Superman or anything else like that. So there are a few different other things here. You can have them with an option A, which is a level death benefit, or an option B, which is an increasing death benefit. I'm going to show you guys both so you understand how you can structure, because you also, while you're doing this, and we see a lot of people who are online, I'm sure you guys face this, who don't quite understand who, what, when, where, why, or how these products are doing what they're doing. If I'm not mistaken, I also have these particular clients. So I don't have them based in New York. And New York has different indices, right? So if you'll see here, you also do need to have a little bit of familiarity with what the S&P 500 is, because if a client asks, hey, what is this? Or if they bring their financial advisor, you as the producer need to understand what you're explaining to them, right? I'm not sure if we have anybody here who's securities licensed. And if you do have questions, if you want to put them in the chat, just put a Q in front of it so that we know when we go over it that you're asking a question. Okay, so as you'll see here, you have the cap S&P 500 1-year point to point, right? You have the 2-year point to point. You have the Russell 2000. You have the uncapped Barclays money market account 1 year, the uncapped Barclays money market account 2 year, and then you have the capped Morgan Stanley International. Okay. You'll also need to see what their current illustration rates are. As you'll see here, they're at a 5.2% current illustration rate. So, as we're continuing on, again, we've illustrated, we see Will Smith. He has this $500,000, but he's tired of it being in that taxable account, having to pay a 1099 in the capital gains every year, and it's simple interest. We know with life insurance, you get compound interest. Now, I haven't even showed you guys yet how the numbers work. Okay, so I also need to change this from a value plus to a growth. So you'll also need to know that and this doesn't just have to be with Emeritus. As you know, we, as an MGA or an IMO, we represent a multitude of carriers. So every carrier is going to have a multitude of products, and you'll also need to understand what product you're putting your client into. For example, here we have the Value Plus, or we have the Growth IUL. If you have your client in a Value Plus IUL, it's likely that that Value Plus IUL is going to be cheaper, but it's not going to be as aggressive toward the growth. So you'll need to understand what product you're putting your client in, and that's why the fact-finding session or discovery meeting is a very important thing. It's the lifeblood of our business, okay? So we have Will Smith, who's age 52, and he's got $500,000 that he's going to pay in for 10 years, because in my opinion, nobody should pay for life insurance for their whole life. So we're going to do this with an option A at $50,000 a year for 10 years. Now we're going to preview that and see what that looks like. I'm not going to go through the entire jargon. I'm not going to explain the guaranteed lifetime income rider or any of that, because most of you guys should be familiar with that. If you're not, we will leave about 15 minutes for Q&A after if you want to go a little further in depth. Okay, so you see here the non-guaranteed policy values at 5.92%, right? Now, this will get him a $1.2 million death benefit with a level death benefit or death benefit option A. Some carriers you use may use option 1 or option 2, option A or option B. They all mean the same thing. It's just like McDonald's has a quarter pounder and Burger King has a Whopper. They're the exact same thing. They're just called something different. So the first year he puts in $50,000. His net account value is $38,000. So that's where he's gaining the interest. His surrender value is in the first year 0. This is with a level death benefit. Why? Because you'll often hear people talk about the fees in these things. There are fees in these things. There are the cost of insurance and the surrender fee. The surrender fee is a 10-year surrender period. So anywhere across that 10 years, there does need to be pain in the program if they surrender. Guess what else has fees? Brokerage accounts. So in that brokerage account, it also has a surrender fee because the brokerage firm needs to make money. They do things like pay you, the financial advisor, your commission. So the insurance company or investment company doesn't make money for the first few years. That's why those fees are there. You have the guaranteed policy values. You need to understand how to explain these to your clients, because often a lot of people will push these and not understand what any of these columns mean. Then you'll get an agent like myself who will come in and rip your whole policy apart, and then you'll get faced with a chargeback. So the guaranteed policy values are the guarantees, which is basically the easiest way to explain it is, well, Mr. Smith, this is like what you've heard of FDIC. These are the guarantees that, God forbid, the insurance company today didn't make another dollar, we would still be able to honor your claim until this point in time. Then you have the non-guaranteed policy values. What are the non-guaranteed policy values? That is what is going on currently. That's what's happening right now today. The reason it's non-guaranteed is because of the indice that we are reflecting, right? So you might say, well, if it's something like the index universal, if it's against the IUL, or excuse me, against an S&P or mirroring an S&P, does that mean that I am investing in the S&P? And the answer to that is no, you are not in the market. Now, I'll explain that further probably in another course because I don't want to get too in-depth with you guys here. But I want to make sure that you guys are understanding this. And like I said, at the end, Charles and I will open it for Q&A if you guys do want to ask some of those questions. So let's move to year 10. Year 10, he's put the whole $500,000 into the IUL. Now, also, let's look at year 1, right? Something that people don't realize that all life insurance does is multiplies your money. So day 1, he put the $50,000 in there, but his money is actually multiplied to $1.245 million. Why is that? Because the moment that he put that $50,000, the moment you put $1 into an insurance policy and the policy is issued, your money is multiplied. Because God forbid you get hit by a bus that night, your family is eligible for the death benefit. In this scenario, in Will Smith's scenario, it's a $1.2 million death benefit. Now, this is with an option A or a level death benefit. Okay. Now, year 10, he's put in $50,000 of cash. He's got a surrender value of $484,000. So let's do some math and pull up the calculator. Okay. Why is my calculator not pulled up? Here we go. So if we do some math, and again, these are things that you should be doing with your client prior to even having your client do this. This is why you want to do a discovery meeting. And then at the end of the discovery, that's why you have myself and Charles here as your principal and your managing associate. Our job is to help you with case design. Our job is to help you understand what it is that you're writing, why it is that you're writing, and what best recommendation to make. You don't want to just push a product and leave yourself, especially in here in the state of New York, leaving yourself open to Regulation 187. Or if you're outside of the state of New York, leaving yourself open to Regulation BI. These are regulations that can get you hefty fines, the loss of licensure, and in some scenarios, even jail time. So these are things that you don't want to face. So you should be leaning on myself and or Charles very heavily to make sure that we can assist you in understanding your case design. Okay? Give me 1 second here. So if we do the calculator, we see 500,000, and then we subtract $484,950. So in essence, over the course of the last 10 years, Will Smith only paid a total of $15,050 to make sure that when he dies, his family gets $1.245 million, right? Now, on the flip side, some products that don't have any cash value attached to them, he may have only paid $15,000, but he doesn't have the possibility of the liquidity to borrow from and or against, right? So he can borrow from and or against this 484,000. However, if you'll see here, the net account value is what your account is growing as, right? Or growing the interest on. So what that means is if he borrows $100,000 from this $484,000, he technically only has $384,000 of cash value. If that was with a brokerage account, he would only be gaining interest on the $384,000. However, in this IUL designed in this manner, he's going to be gaining interest on the $488,000. That's the account value. Okay, so again, it's very important that you understand the ins and outs of this product, right? And I believe I did invite a few advisors who aren't with us. If you aren't with us yet, hopefully you'll consider joining us. We are a small boutique firm. Okay, so you do get a lot of attention from us. Now, if you'll notice here, he's age 63, but there's $0 in the premium outlay. So that means that there's $0 coming from his pocket, but the policy is still increasing. If you'll notice here, year 11, he's got net account value and cash surrender value of $514,000. So if we pull up the calculator and we put 500,000, right? And so 500,000 minus $514,321, you see negative $14,321. So in essence, that means that by year 11, the life insurance company has now paid him $14,321 to make sure that when he dies, his family gets at least $1.245 million. Now, if you put that in a brokerage account or a term policy, you may not get the same benefits. Is there anything wrong with a brokerage account? No. Is there anything wrong with a term policy? No. It's very similar to having a vehicle. You need 4 wheels in order for the car to go. If you only put everything in this IUL, you're giving your client a disservice. We're as advisors supposed to give a holistic plan. That's why we do holistic planning and we do the fact finder. So it's very, very important that you don't just say, hey, Bob, or hey, Will Smith, how much do you have to spend? You say, hey, Will Smith, you and I need to sit down and I need to go over your numbers and do an intake form. If they seriously don't want to do it, you may seriously not be able to service them as a client. Now, in essence, he's been paid. You guys may have heard of things like the whole Chase Bank glitch, right? Where people were, getting thousands and thousands of dollars, and now suddenly their account looks like that: negative 15, negative 20, negative $100,000. That negative means that they owe Chase Bank $100,000. So when you see a negative from the insurance company, that means technically the insurance company, since you have that cash value available to you to access, that means the insurance company basically has paid you to have life insurance. Okay, so this is also going to give you the ability to arm yourself if you're ever in a competitive situation. This is generally why you don't see myself or Charles going online battling back and forth with other advisors about term insurance is better, whole life insurance is better, because we understand that. And we'd rather service the general public and our client. Okay. Now, I'm going to show you a different scenario, right, with option B, or an increasing death benefit. Because the idea is you want to make sure that you set your client up for success. Okay. So if we do an option B, or an increasing death benefit, you'll see here that in year one, unlike with the level death benefit, in year one, he had a $1.245 million death benefit. His account value is $38,000, and his surrender value is 0 in year one. Okay. Now let's look at the option B, or increasing death benefit. If you'll notice, he has a substantially lower death benefit to begin with, almost cut in half. It's now a $630,000 death benefit. Because again, when you're looking at properly structuring an IUL, the idea is not to buy a lot of death benefit. It's to buy a lot of cash value, or accessibility to cash value. So you'll often hear people say, if it's properly structured, and they don't know how to properly structure an IUL, or what a properly structured IUL looks like. I've been doing this for a number of years. I'm very well versed in it. I am an expert in it, and I'm still learning stuff about it. So if you're licensed for 2 to 4 years, you might know some stuff, but I promise you don't know a lot about this, right? So let's look. Year one, he's paid that same $50,000. But if you'll notice, his account value is now $43,611. And a lot of people like to see some cash value available to them in the first year. So in the first year, he's almost got 50% of what he's put into the policy, $23,968 of cash surrender value available. Now, let's fast forward to year 10. Year 10, his death benefit is increased to $1.192 million. Again, that goes to the laws TEFRA, DEFRA, TAMRA that we've already spoken to you guys about, right? TEFRA, DEFRA, TAMRA, and you also want to make sure that it's not a MEC, a modified endowment contract, because you don't want to have your client in a situation where they face tax penalties, right? In later trainings, I'll talk to you guys about things like single premium insurance, where you kind of do create a MEC for your client, but there's still tax savings, right? That is high level stuff. You guys might not be ready for that yet. Now, and a lot of your clients likely aren't ready for that yet. Now, again, remember I told you, you want to put your client in a position where they're being paid to have life insurance. So this guy initially, his contract is only for $630,000. However, you'll see here by year 10, his death benefit is increased to $1.192 million. His net account value is $561,000. His cash surrender value is $559,000. Now, let's pull up that calculator. Like I always tell you, trust but verify. So if we do 500,000 and we subtract 559,711 and hit equal, you'll see negative $59,711. So what that means now is that the insurance company has paid him almost $60,000 to guarantee that when he dies, his family gets $1.192 million. So this is the beauty of actually knowing how to structure the IUL. Are you going to know how to do it from just this one training? Absolutely not. That's, again, why you have Charles, your principal, myself, your managing associate, to lean on. You go do the fact finder and you tell the client, hey, client, I'm not a product pusher, so we don't do one call closes. What we do is we sit down and then I take this back to my team. A lot of people want to be hyper independent and not let anyone know that they have a team with them. You have a team of agents with varying levels of experience, right? I've been in this industry almost 16 years now, right? When I first got into this industry and heard people talking like this, my mind was blown. I never understood it until I actually took the time to study, right? Charles and I do have a dynamic perspective because we started on Wall Street. Our initial office was 100 Broadway. You would come outside, take 2 lefts, the New York Stock Exchange was right there. So we had no choice but to be in the belly of the beast with the sharks and learn what the sharks know. Okay, so that's case number 1, right? And this is with a 10-year strategy. You can do it with a 5-year strategy as well, right? So let's look at a 5-year strategy. Instead of them doing $50,000 a year, let's do $100,000 a year until age 57. Okay, so we're going to do, again, option A, right? And you want to make sure that when you're setting up the face amount, you're setting it up for a minimum non-MEC. So minimum non-MEC means the minimum death benefit for the maximum amount of money. This is what they mean when they say overfunded or max funded. So you need to make sure that your client understands technically they are overpaying for a certain death benefit, right? So if they want death benefit, the IUL is not the product that they should be in, okay? The IUL is more for an accumulation structure or a tax benefit. Give me 1 second there. Let me my phone is ringing. Okay, sorry about that. I had to mute my cell phone. So if we look here and we do the 5-year pour-in strategy, generally you would think, well, the 5-year, won't that obstruct with Tamra 7 pay? It may. However, there are ways, and again, our software actually kind of helps us to avoid that. So if we preview it in a 5-year structure, you want to make sure that your minimum non-macking it. You want to make sure that you're inputting the premium, and you want to make sure that you save for age, or not, I'm sorry, not save for age, but illustrate to a specific age. Okay. So when you illustrate to a specific age, you'll preview. Okay. And again, I did this with level death benefit. Okay. So if we look here and the 5-year pour in, right? So 1, 2, 3, 4, 5 years, and then he stops paying. So again, he's only paid the $500,000 into the policy. We're going for a $1.2 million death benefit. And then at the end of 10 years, he's got $582,000 worth of cash value. So that means that the insurance company paid him $82,000 to make sure that when he dies, his family gets $1.245 million. Also, along the way, he has the ability to touch some of that money without penalty, okay? Because he's likely going to take it in the form of a loan, and loans are not taxable. Now, if this was an IRA, whether that be Roth or traditional, he could not touch more than $10,000 of that money for a first-time home purchase, a hardship, or for adoption. But as soon as he touches $10,001, the IRS he's going to face an IRS penalty. Okay? Now, once he becomes 60, that goes away. But he can touch that money year 1, 2, 3, 4, 5, 6, or 7 until 7.5. Okay, 7.5 years being where he would be 59.5. So that's it for Will and Jada Smith. Let's look at another case study, right? So another case study we have here is the Carters. So Jay-Z and Beyonce Carter, or I'm sorry, Sean and Beyonce Carter. So, with a successful career as self-employed entrepreneurs in the arts, the Carters realized that they needed to get serious about setting money aside for their retirement. They veered away from IRAs and chose a laser fund because they understood the value of paying taxes on the seed rather than on the harvest. They put about $3,000 a month into their policy to maximum fund their policy, but they wanted to do more. They then sold their large home and downsized to a beautiful retirement community. Well, I should have just said a beautiful gated community. I'm sorry. I was thinking of retirement age people. But Sean Carter is substantially older than Beyonce Carter. They then used the $300,000 from the sale of their home, which was capital gains tax free. Again, you should have some knowledge of securities and some knowledge of taxes. So a great thing as advisors that we should be doing is partnering with a securities licensed professional if you don't already have your securities license, right? You should be partnering with a CPA or an EA if you don't already hold your PTIN, your prepares tax identification number, like I do, right? Even though I hold my PTIN, I don't tell my clients that I have that because I don't want them asking me for tax advice because I'm not a tax advisor. That's not my job. I'm selling insurance. Okay? You may want to call yourself an insurance-based financial advisor. Okay? Now, we're going to take a look at the Carters. So let me pull up the Carters here. As you can see, I have quite a few different cases in here. All right, and we're going to do this again in live time so that you guys can see this in live time. I'm going to close out the Smiths cases because we've already taken care of Will and Jada. Now, again, these are the IULs. Oftentimes, IULs are not going to be for your average client. You want to make sure about this thing called persistency, right? Persistency meaning that the business stays on the books. There's two reasons for persistency, and this is more for the client's benefit, not your benefit. When you start thinking about the client more than you think about yourself, your career will explode. Why will your career explode? Because people will start wanting to give you money. When you start off thinking about yourself or thinking about, hey, everybody should have this particular product, you're thinking about yourself, not your client. So, again, in this scenario, right, they're going to put $3,000 a month into a max fund IUL. So we're going to use Beyonce Carter. She's age 41. Again, we're not going to worry about the input of the face. Remember, you don't want to do the input of the face and you don't want to do the percent of target. Now, briefly, what I'm going to show you is the input of target because you need to understand the differences of those. Now, we're going to keep this one paying in perpetuity because they didn't say that they're paying for a certain period of time. So we're going to do $3,000 a month or $36,000 a year. Let's first
Hey,
look.
Alonzo, sorry. Hey,
Yes.
in the interest of time, just keep it the minimum non-met because we're
Okay.
in the interest of time. Thank you.
All right. So in the interest of time, we'll do target in another training. Okay. So you look here, they're putting $36,000 a year into the policy. Again, you want to make sure that the client understands that they're going to be putting substantial amounts of money into these policies. So if we preview that, okay. And we see here this is a minimum non-met, $36,000 of annual premium into the policy with a level death benefit. Now, this is in the state of New York. If you'll notice, there's a lower non-guarantee. I'm going to show you guys that really briefly after I show you this. Okay. So again, at the end of 10 years, she's put in 360,000, but she's still got access to 328,000. Okay. At the end of 20 years, she's put in 720,000, but now she's got access to 962,000. She's also got a $2 million death benefit. Okay, so she's immediately multiplied her money from day one, right? So last scenario, if she puts in option B and we preview, or what's called an increasing death benefit, right? So now we've got, well, I did take a little longer than I thought. I thought I would only take 30 minutes, but you guys know when I get excited, I get to going. And if you don't know, now you know. Okay. So in an option B or an increasing death benefit, she's got a $707,000 death benefit. But again, year one, she's put in 36,000. Year one, she's basically got half of what she's put into it as cash value available to her. At the end of 10 years, she put in 360,000, but she's basically been paid $40,000 for making sure that when she dies, her family gets $1.1 million. You want to look at the 20-year time horizon, right? Because that's the most commonly sold term insurance policy and the most commonly notched time horizon investments. Again, most of you aren't securities licensed, so you might not know about what a time horizon is. So 720,000, but now she's got access to $1.1 million, and the death benefit keeps going up. So this one is paying in perpetuity. The more they put in, the more they get out, right? So again, that's why you want to lean on myself and Charles to make sure that you understand that, right? In the interest of time, I do want to show you guys one more thing. Where is the, you know what? I'm just going to pull it up on Producer Workbench.
Hey, Alonzo, before you do that, can you run that same illustration showing like a 50,000, like a 50,000 dump in? That's and have the payments, the premiums go to age 65 and turn on the income rider at age 65.
Okay, so we want to do the GLIR rider as well?
Not that the income rider.
Yeah, the guaranteed lifetime income.
Yes.
Okay.
So we have the payments here going to age 65. That's option B. And turn on the income rider. It's already on, but start it at age 65.
All right, here we go. Cash flow.
No, not there. Go back to the riders. Yeah, you see that? You see where's the income, the lifetime income rider?
Oh, okay, I hear
Yeah,
see
put the start at age 65.
65.
So this way she's paying a premium for retirement age, and then you can see the income stream. And
And
this is because this is a small business owner.
you want to do the dump in first year of 50,000, correct?
Yeah, you can do a dump and she has an extra 50,000 she wants to put into the policy.
Okay. So
So I
you
just
can
want
also
everybody, so everybody can see how flexible these plans are. You can really just custom design and build a program for your client.
Okay. So as you see here, we put in the lump sum of 50,000 additional dollars. Now she's still going to be doing the $36,000 a year, but the first year she's going to be doing $86,000, right? So you put that in lump sum. Now you'll also see that they have the option for a 1035 exchange. We'll talk about that later. So if we preview here, with that dump in, you're going to see another incredible difference.
And again, if anyone has any questions, feel free to just put it in the chat and we'll
Yeah, let me
address it
check
at the end.
if we've got any questions. I don't see any questions as of yet. Make sure you guys ask questions, or we can always open it up. So if you'll see here, the initial monthly premium is 3,000, and that lump sum is 50,000. Okay. Now, if you look here, year one, the premium outlay is 86,000. Her account value is 75,000. Her surrender value is almost 100% of the annual premium she paid in, right? In 32,000, right? Now, at the end of 10 years, she's put in 410,000. She's still got access to 396,000, right? And so it beats up the cash value. Now, if you'll notice here, age 65, the premium outlay stops going in, okay? Because now she's going to start receiving, it's not showing on the hold on, I got to show the cash
It's up,
flow.
it's up. It's like it's on the second page, the second or fourth, the third or fourth page, up the other way,
Oh, no. Okay, here we go.
the other way, like the third
Yeah,
or
that's right.
fourth.
Yeah,
It's
it's
early
highlighted.
on in the illustration.
Well, so there's a way you can actually illustrate it. That's why I was going into the writer. You can illustrate and select how much money you want them to
It's like
receive.
the third or fourth page,
Should
Alonzo's.
be right here, right? Right here. Here we go. So
No,
in
up some
this,
more. There it is. There it
yeah,
is.
right here. So in this scenario, she can be getting 75, almost $7,500 a month at age 65 for life. Right? So that can be until age 85, age 100. Obviously, it can be longer. They just illustrate these two. That is what the level guaranteed lifetime income. So at age 65, when she has about $1.4 million of assumed cash value available, excuse me, she'll also be able to trigger a guaranteed lifetime income. Now, that income, if I'm not mistaken, is taxable, correct, Charles?
No, it's tax
Oh,
free.
it's tax free. Okay. I don't know why I thought that was taxable.
No, the rule 72E, that's how the accumulation grows tax free, and also the withdrawals are 100% tax free because it's coming out of the life insurance.
Okay.
And that's the rule 7702 that allows you to access the
7702.
the growth of the policy tax free. And
So
just one
that.
more example before we wrap up. Just change that same scenario to option B. I'm
Mhm.
curious how the cash value will look. The same scenario, but option B.
Option B. Gotcha. So now we're going to do this same scenario, the $50,000 plan with the $36,000 annual premium, but we're doing it with an option B, or an increasing death benefit.
And go back to the income rider.
Oh, I went right past it too.
Yes, I don't know why they put it in the beginning. That should be in the back, so it's easy to miss that.
So as you'll
There
see
it
here,
is.
it's almost $8,000 a month that she'll be receiving. So even in the first scenario, with her paying $3,000 a month, when she does that guaranteed lifetime income, she's getting more than double what she paid into it for life. Now, they'd have to trigger this. There are, parameters they'd have to let the company know. It's not something that automatically happens, but you need to understand the options that are available to your client. And again, that's why you guys want to lean on myself and Charles. Okay? So you understand the options that are available to you for these things. Okay? Now, what I wanted to show you guys here was, where is it? Rates October. I had this thing yesterday. Here we go. So these are the October rates on the IULs, right? So first we're going to look at the New York rates. So there's a law called AG 49, right? The reason AG 49 exists is because, again, like I said, there's a lot of agents who have no clue who, what, when, where, why, or how the IUL works. So they're running around saying, hey, yeah, you're getting 1,000,000,000%. So AG 49, the federal government said, we can only illustrate these policies a certain way. Another reason is so that they save the investment industry. Because most clients, if they saw these interest rates, they'd be like, well, why would I go there and get a non-guaranteed interest when I can come here and get a guarantee? So we can only illustrate in the state of New York to a maximum of a 4.9% rate, right? And I'm just showing you guys the S&P 1 year point to point, right? However, what they're currently getting, so we're under promising and over delivering when we're giving to our clients. This you should not tell your clients. You should only tell your clients about what they see, the 4.98%. Just know that when they get their statement, you'll be able to say, yeah, it actually did better than we initially told you. So if you'll see here, the maximum illustration rate legally available in the state of New York, 4.98%. But the maximum current cap rate that they're actually going to be getting is 7.5%. So they're getting almost 2.5% more than we're showing them what they're getting. Now, again, the reason that we cap that is because I always sold on a 2% interest rate because I like to under promise and over deliver, right? 2% isn't sexy at all. But when I tell you 2%, you look at your statement and you got 7%, you're going to be like, man, this guy, I don't know if he knew what he was doing, but whatever he did something great for me, right? Again, those are the state of New York. A lot of people don't like to sell in the state of New York. A lot of carriers pulled their business out of the state of New York. Let's look at outside of the state of New York. Their current max illustration rate is 5.9%, right? And again, this is on the S&P 1 year point to point. But their current cap rate is actually 9.25%. So they're getting nearly 10% compound interest over the course of 1 year, right? So then you'll need to understand what all of these indexes mean. What is the S&P 1 year point to point? What is the 2 year point to point? What is the sector rotator RC2 5% 1 year point to point? What is the S&P Mark 5? What is the BMP or Barclays momentum multi-asset 5 index 1 year point to point? What is the Barclays multi-asset 5 year index, right? 2 year point to point. If you'll see here, the fixed account, a lot of whole life guys like whole life because they have the guarantee. If you'll see here, you have a 4% current interest rate on our fixed account but you still have the guarantee of 1%. Again, this is outside of the state of New York. Most of you guys are in New York, so you'll want to look at the New York rates. Okay? So in the New York fixed account, you got a 4%, but your guarantee is 2%. But you also only have the Morgan Stanley International, the Russell 2000, the S&P 500 1 year monthly, the S&P 500 2-year point to point. You now also have the S&P 1 year point to point high participation, which has a 5% cap, but it's at a 140% par rate. So if you guys aren't securities licensed, this may be stuff that's going well over your head. I am not securities licensed either, but I've studied for all of the security licensure as well as the CRC. I'm also likely going to join the IARFC, which is the International Association of Registered Financial Consultants. It's a very good idea to be part of these things, especially, you'll get the knowledge that I got, which is how I became the IUL expert, right? Because a lot of these guys are MDRT qualified, MDRT being the top 1% of agents in 80 countries. Okay, so that's it for me. I'll stop my screen. I guess we can open up for Q&A.
Yes, yes. Thank you so much for that, Alonzo. That was a great job. Awesome.
Thank you.
Awesome. Two of those and you on your way to Hawaii next year. Two
Yes.
of those cases there. So I'm looking in the chat. I don't see any questions. If you have any questions or something you need clarity on, feel free to drop it in the chat. Or you can raise your hand. I can take you off mute if you want to come on stage. But I don't see any questions. So Alonzo, I'll ask you, like,
Mhm.
when you show somebody this, what is the what when you show that, because this is for me, I'm looking at it like it's a liquid, like the cash value is liquid, right? Because you could pull it out, like you said, in the first year, second year, you could access the cash value anytime without any 10% IRS penalty, right? You showed how safe it was. Even on the illustration rate, what you were showing on the illustration rate, those numbers are really like double, right?
Mhm.
And it's in the S&P 500. So you
Mhm.
see, it's pretty safe. The rates are predictable. We get it and then the tax advantages, right? You have the cash value coming out. You could it's accumulating tax free, and you can access the cash tax free. On top of that, you have the death benefit tax free, kind of like a Roth, right?
Mhm.
So when you show
Well,
somebody this, what are the objections? Have you get When you do get an objection, what is the objection? Like when someone says no, I mean, I'm sure you haven't had an objection, but when you get it, what are the typical objections that you hear when you show this?
so generally, when I show this, I don't really get too many objections. One of the funny things, and this, guys, is why you want to understand how to properly structure it.
I mean,
Structure it.
but when you do, what is the objection? You
Um,
don't have 100% closing ratio.
No, no, no. So generally the objection it is expensive, right? And most people are like, wow, well, I didn't know I'd put that much in. So often in a lot of those scenarios, you're looking at people who are again, they're gonna be like, the Carters, right? Um, Oftentimes the major objections are health concerns, right? Oh, I weigh a certain amount, I take a certain medicine, I don't know if I'll qualify. And a lot of people don't want to take the health exam. They want, simplified issue products because again, a lot of agents are pushing simplified issue, which simplified issue is okay. But after so many years in this, generally what I tell people is listen, apply for the most you can get. Just because you apply for the most you can get doesn't mean that you have to take that. But if you apply for 1 million and then turn around and say you want 10 million, then we have to go through more underwriting. So from the beginning, apply for 10 million. And then when they say, okay, you're approved for 10 million, say, okay, well, I only want to take 1 million. They will have no problem with that. So the major objection I get is it's expensive and I can't qualify for it health wise. I don't want to take the physical exam.
That's great. And also remember, Meritus has you can get up to 2 million without doing a physical exam. So
Mhm.
if that's a concern for someone, you can get up to 2 million if they qualify. Do you hear anything? This is not an investment like It's not an
So
investment. This is insurance. Have you heard that one? I've seen that on the internet.
yes. So my answer to that very often is it is not. And there's two. So generally, when I hear that, I say, well, let me give you the characteristics of two different products, right? And then we'll see what's better. So, product A characteristics, you have an unlimited amount of principal you can put in, you have an unlimited amount of gain that you can experience. Um, However, there is also an unlimited amount of loss you can experience because you have exposure to the market. If you pull out from it, even using FIFO, which is first in, first out, meaning you take out the principal first, you have the possibility, you have to pay capital gains tax. Okay. And when you pass it down to your heirs, they're likely going to have to pay income tax and or capital gains tax. That's product one. Product two, you have an unlimited amount of principal that you can put in. There is a cap to the gains that you have. However, there is zero market risk. You also likely, if properly structured, have no tax. You eliminate tax liability because it can be accessed tax deferred and tax free. If you pass it down to your next generation, it will likely go to them without capital gains tax and or without income tax. So, Mr. Smith, from product one to product two, which sounds more attractive to you? Overwhelmingly, most people will say product two because I like the guarantees, and taxes is one of the most expensive things that I ever see there. And then I say, well, product two is a life insurance policy, it's not an investment. And I think insurance is insurance and investments are investments. You should have investments if you're properly set up. But there's something that we say in the MDRT, which is CSI, coverage, savings, investments. So you start by protecting your most valuable asset, which when I ask a lot of clients, what's your most valuable asset? What do you think most people say, Charles?
Their house.
11 times out of 10, that's what people say. My house is my most valuable asset.
Yep.
And I
Hmm.
have to explain to them, sir, your house is a very valuable asset, but it is not your most valuable asset. Your most valuable asset is your ability to earn an income. Because if you didn't earn that income, you couldn't have purchased that house or financed that house, right? So your most valuable asset is you, the ability to earn an income. So coverage, meaning that you have that coverage. And if you have a permanent life policy, you're also almost creating a forced savings because there's that savings component in the cash value of the life insurance. Now, some people just don't like it. They're like, one of the objections I'll get is, why would I do this when I can put it into something that can get me 10%? And I'll ask, can you guarantee that 10%? What happens if you lose 20% on $100,000 and then the next year you gain 20%? Are you back to that $100,000? No, because 20% of $80,000 is substantially less than 20% of 100,000.
Exactly, and that's the safety component because the floor is zero. So
Mhm.
even if the market crashes, it's going down to zero. So, with that said, Alonzo, way up on the top of the hour. Like I said, I really appreciate you. Right, I think this is a great product. And you just have to design it properly. Like Alonzo said multiple times on here, you have me, you have him, you even have a sales support number. Like if we're not available, even there's an 800 number, you can call sales support and they'll actually design you a program. But this is not for every client. This is good for business owners, people with money that's looking for, that need some type of tax advantage
Mhm,
program. We didn't even mention the Care for Life rider. That's
mhm.
something where they can access it. And then you can also structure these as an executive bonus
Mhm.
plan. Like you have a business, you can structure this as a Section 162. Now the premium is also tax deductible for the employer. I mean, there's so much opportunity in this. You just have to so today I just hope you at least at least got some ideas from this, and we
Mhm.
can, and really the trick is to really study and go more into it. So like I said, I don't see any questions came through in the chat. So with that, everyone, have a great day. Anyone that's in the south, be careful. I hear this storm is coming, and it's going to be catastrophic. So be safe. All right, everyone, have a great day. I
And
appreciate it.
guys, also ask for the next training if you guys want like annuity training. or what, let us know. You got to help us help you, right? We don't know what issues you guys are facing, and our job again is to be here to help you guys to grow your business, right? So you'll hear it. It might sound cliche, right? You're in business for yourself, but not by yourself. We actually stand behind that and mean that. So you have to come to us to let us know, what issues you may be facing. And glad to see you, LJ. Maybe you, I, and Charles will talk a little bit later about everything.
All right, everyone. Have a good one. Take care. All
Take
right.
care.